Hey, it's Michael Tiny Saul, and around this time of the year, today is December 27th, 2011 at 2:30 in the morning, I usually do a class on the January effect. So rather than do a class this year due to scheduling conflicts, I've decided to do a video, and this way, maybe it'll be evergreen, maybe I won't update it, but more than likely I will. But anyway, for this year, we're going to do a video. So let's get started. First things first, read this disclaimer. And I know usually when you see these disclaimers, they go in one eye and out the other, right? Because you're reading it. But it's very important to understand that this class is for educational purposes only. Do not believe the criminal super hype gurus that tell you this is the one and only trend or tendency or occurrence in the market that you should trade and that you have a chance to make hundreds and hundreds of percent gains. It's all hype, and it's all nonsense, and it's all a way to pick your pockets. That's what they're there for. And look, I'm sorry, I know it's unprofessional to talk about the competition, but in this case, they're not the competition because they're charging ridiculous amounts of money in order for you to get a list that they stole from other services. This video is free, and the stocks that I'm going to talk about, that's going to be free also. All right, now that doesn't make me, somebody that you should probably sculpt out a statue of either. Okay, but just be real careful about paying hundreds and hundreds of dollars to people who are going to be front running you on the positions. All right, that's not going to happen with me, and I'll talk about that as this continues. But this tendency does not always work. All right, we are in a period right now in the market over the last decade where we've seen an increase in the net gain on the market for the last, I believe, 11 years in a row from Veterans Day, unless something tanks this week. All right, from Veterans Day to the end of the year, but we'll see. And I don't know if that's going to continue this year or not, but I think we had 10 years in a row where that happened, and some stat I read was 22 out of 24. That's not what this video is about. But, when that kind of, there's a saying, a rising tide carries all markets or whatever it is. But, when you have that kind of rising tide and when there's that tendency into the end of the year, all right, it's easy to sit there and go, this is just amazing. Well, all right, I mean, maybe, but things can change, okay? And it's not like it's happened every single year for 100 years and you can't lose. Please, just understand that. I'm sorry I took so long on this disclaimer, but I feel it's really need to be said because it's disgusting what some of these, I mean, there's no other word other than criminals are doing out there. Besides picking your pocket, they're also front running you, and it's just horrendous. Anyway, here's the CFTC rule. Okay, now what is the January effect? Now, the January effect has come to be interpreted in a few ways over the years. The first, and I believe the original way, was that small caps outperform large caps into the end of the year and the beginning of the new year. Now, I start to watch for this about the middle of the month. I start to watch to see if the Russell starts outperforming. A great way to, track this is just look at the Russell 2000. All right. Now, the second way that people quote the January effect are that beaten down stocks get a lift into the first few days of the new year. It doesn't necessarily have to be small caps. And that's the way that I interpret it. All right. I look for beaten down stocks for the current year. We're in 2011 when I'm doing this video to get a lift into the first few days of the new year. Now, all the stocks, no, not necessarily. We'll talk about that more. But, that's the general theme, in my opinion, of the January effect. Now, what are the reasons for the effect? All right. First is window dressing. So what's window dressing? Window dressing is when fund managers tend to dress up their performance. They like to pad their portfolios with big winners and dump the losers, so they're not on their books. And between that and tax selling, which is when investors, whether it's funds or individual investors, they have losses on some stocks, they sell them for losses in order to offset the gains. Now, both of these, window dressing and tax selling, can further push these already depressed stocks further down. All right. Then new money is put to work at the beginning of the year from pension funds, just from investors, or just mutual funds that are not pension related. They just have money on the sideline. And new money is put to work, and some of that new money goes back into stocks that was sold into the end of the year. Maybe they did tax selling, or maybe they did window dressing, but maybe they still liked the story of the stocks, and now they could get them at even cheaper prices, so they put new money to work. All right, now, don't kid yourself, okay? For those bargain hunters, for people that are looking for these depressed stocks, for stocks that have been beaten up and they're looking to scoop them in, once they see some buying pressure coming in, okay, it can cause a chain reaction, and more money can be put to it, into these stocks, and it could just, form either a little squeeze, or it could, some of these stocks don't trade on a lot of volume, so they can easily be pushed up. Now, is that manipulation? I don't know. I mean, I put a question mark next to it because I'm not one of these conspiracy theorists. Maybe I should be one, but I'm not. So is this market manipulation? Maybe. I don't know. But I think more than that, it could be an SFP, which is a self-fulfilling prophecy. A lot of people are aware of this tendency, are aware of the January effect. Not just the people that are watching this video. There are plenty of searches online for it. Like I said, plenty of these criminal super gurus doing classes, charging really crazy rates. So I mean, there's a lot of opportunity out there for people that are looking to participate in this. So it could be a self-fulfilling prophecy. All right, that I think is more than manipulation. All right, so when does the January effect happen? Well, I start watching for the small caps to outperform the large caps starting in the middle of the month, but I don't look for the January effects, the beaten down stocks, end of month into end of year into beginning of new year to happen until the end of the month. Now, another thing that these scam artists do when they give these classes is they don't give specific dates. And that's because they make like these crazy guarantees, and then they never want to pay up on them. So they're like, oh, well, you didn't follow our rules. If you followed our rules. And so, I mean, that just makes it, completely arbitrary, completely ambiguous. So there's no real reason to try to follow those entries from them. Now, the way I do it, okay, is I have a specific date range. All right. So I look for the end of the month, the close on the fourth day prior to end of year. Okay. And I may be saying this wrong, fourth day prior. So officially is the last, it's not the fourth day to the last day. It's 4 days from the end of, the last four, the close of the fourth trading day to go to the end of the year. Okay. And then I'm looking to sell, okay, or an exit signal. So it's an entry signal, fourth day to go, close of the fourth day to go. There's an exit signal, okay, on the fourth day of the new year. Okay, this is a mechanical system. That's the framework that I'm using for this video. Some people will hold January effects the whole month of January. Some will even hold into March, I've read. I mean, to me, it's always been last four, first four. And of course, if they're moving, once again, you'll get these scam artists who put out these lists and go, oh, well, you should have held. There is no woulda, shoulda, coulda here when I do the video. Right? I have a specific framework. For this year, 2011, the entry signal is the close on 12/27/2011, and the exit is on January 6, 2012. Now, it could either be at the end of day, or if the the stocks are up into the noon time hour, right? 12 o'clock, 12:05, 12:15. If they're up into that, that could be a discretionary sell signal as well. All right. So when I do the recap of the stocks and I post them on my blog, all right, I either use the close, or if the market and the stocks are up into noon, then I look to get out somewhere around that. So here's SPMD is an example from last year. So here we go with, I numbered the days to go, right? So the entry was on the close here, fourth day to go, third day to go, second day to go, last day of 2010, and then first day, second day, third day, fourth day. Now notice that this trades as high as 1238, but I marked it as an 1189 exit because you have to be accountable, and you're not fooling anybody by saying, oh, you could have got out up here. Maybe, but rules are rules, and this wasn't the close, but the stock was up into the noontime hour as 1189-ish, okay, and probably a little bit higher, not by much, and it went as high as 1238, and that's a big percentage difference. But, I'm not going to get anywhere lying. There's plenty of criminal super gurus out there that you can listen to if you want to, and they'll be happy to lie to you and tell you how much you could have gotten or should have gotten, whatever. But in the end, it's not going to help you. So this is an example. Okay, the fourth day to go, fourth day into the new year. All right, so money management. As always, money management is the most important part of any trading business plan. If you think it's the picks, or you think it's the trend, or you think it's that the January effect overrides all money management, please don't even look to get involved. Okay? Money management is the most important part of this trading plan. Okay? Even with something as powerful as the January effect. And I say that tongue in cheek because it's just one trade. So a couple of different ways you could do it. You could do a certain allocation per stock. You can say, I'm going to allocate a certain dollar amount to each stock or each option. I'm going to buy $2,500 worth of every stock, or $2,500 worth of every option. Okay, now, are some of these stocks going to be marginable? Yes, some will be above $5, and there were I believe, other brokerages that will even let you margin for lower than that. But whatever it is, some will be marginable. So that's a way, if you choose, that you can perhaps buy more than what your cash account allows you to. And this is a swing trade, so the more margin you use, the higher the risk. Right, even 2-to-1, it's higher. The risk gets higher and higher and higher. Okay, so another way is the equal percent rule. So rather than a monetary allocation per stock and option, you may want to do an equal percent rule. So you may want to say, okay, I'm gonna take 20 stocks that I like for the January effect, and I'm gonna diversify, so I'm not taking all in one sector or whatever it is, and I'm gonna allot 5% of my port to each of those stocks. That's a way to do it. Okay. Now you may say, whoa, that's, I'm putting all my money in. Well, yeah, if every stock goes to zero, then you'll get completely wiped out. The account will get completely wiped out. Now, if you're using stocks like Dow stocks, which we'll talk about in a little bit, I can't sit here and say it can't happen, but, for the Dow stocks to all go to zero, I mean, the world is going to have to be in a really horrible place for that to happen, for the Dow Jones to just stop trading and everything going to zero. All right, so just think about that. Yeah, if you're going to look for stocks, oh, this is cheap. Look, this is 5 cents. Yeah, you have a real good shot of losing everything. Okay, but usually these stocks are not in the pennies. Okay, they are still trading on the major exchanges, and They're just really depressed and really beaten up. So that's one way that you may say, hey, you know what? I want to put 5% into 20 stocks, and this way, if you get mixed results, okay, then you're not going to get hurt that bad. Also, remember, if you're putting 5% of your portfolio into a single stock, all right, and that stock goes down 10%, you're really only taking a 0.5% hit. Now, look, I'm not saying that if everything goes down and you're taking 10% hits across the board and you're going to wind up losing 10%. I'm not saying that's something that you can just say, oh, no big deal, let's move on. No, it'll suck, but it's a way to protect yourself rather than using margin and doing all these fancy things, going crazy with options that can expire worthless, which, that's one of the tricks that the super gurus use, is they call options on a lot of these trades, because if they're right, hey, they're going to be able to brag, oh, up 1,000%, up 500%. But if they're wrong, they just sweep it under the rug. No big deal. I told you to go small. That's what they'll say. They'll never take the blame. All right. Money management, very important. All right. Now, how do you find the stocks? Well, you can get a scanning program. There's a lot of good ones out there. TC2000 is one of them. And you could scan through the stocks, look at relative performance, look for the stocks that have been beaten up on the year. And, the stocks that were at one time in favor are sometimes the best ones to choose. There's the low-tech method, which is just go through your database. Get a database program, get a charting program, and just go through the stocks. My suggestion is always to remove the ETFs. Okay, so I like to just do this on stocks. All right. Another way is something called the Dogs of the Dow. The Dogs of the Dow is a semi-famous, I guess, methodology or strategy, whatever you want to. More of a strategy, I would guess. And what you do with the Dogs of the Dow is there are a few different ways to find them. It's either the best yielding Dow stocks or the biggest losers. Sometimes they're the same, but sometimes they're not. Sometimes the biggest losers aren't the best yielding. I don't know. That's what I've read. Okay. What I look for is the biggest losers on the year. So you look for the 10 biggest losers on the year. Out of those 10, the 5 cheapest are known as the small dogs. Okay, they're the cheapest out of the 10. And now the Dogs of the Dow, usually they're held all year. But I like to use the Dogs of the Dow the same way as the other stocks. I like to go in the close of 4 days before the end of the year and look to get out 4 days into the new year. All right, this is just one way of doing it. You have to make your own decision based on your own risk tolerance and how you want to trade them. Okay? Go to www.dogsofthedow.com for more. This is not my website. Okay? So you can go there and you could find out more about the Dogs of the Dow. Here's some performance that I've done. This is my own performance journaling, I guess would be the best way to put it. This isn't audited, and this doesn't include any commissions or anything like that, any dividends. There were no dividends in that little time, I don't believe, but just in case, all I did, this is just raw price performance, and these are percentage gains, okay? So these are the 10 into 2009. So when it says Dogs of the Dow 2009, that means it started in 2008, went to 2009, okay? So you see here, really good year. 2008, not so good. Okay, I believe there was one winner, Pfizer. These are percentage losses. Okay, so not good. But if you allocated, let's say you just did the Dogs of the Dow. Okay, if you allocated 10% to each, I don't know the average here, excuse me for that, but let's say it's a 6% average, which would be terrible. Okay, then you would lose 6% on the whole portfolio if you put 10% into each. I don't think it's 6%, but you can figure it out yourself, all right, on this. But I'm just showing you that it does not win every year. Okay, here's 2007. Had mixed results. I think it still came out a winner, but not by much. 2006, a couple of stinkers, Walmart, Home Depot, but a couple of nice, couple of okay ones, Pfizer. All right, and for the dogs of the Dow for 2011, okay, all 10 had winning trades. Now, I don't do percentage. I didn't do percentage results. I did actual monetary results, actual point gains. And in 2011, all 10 made money. Walmart was the smallest. Entry was 53.74. The exit was 53.96. But go to my blog, okay, and do a search, or you can look, the categories are on the right, go to January effect, and then scroll down. Okay, 2010, if I were you, to see how this did, I would go and I would grab some charts and do it yourself. Put some work in, okay, really, because it's going to benefit you. You can also go back further than what I'm showing, 2006, go back to 05 and 04, 03, 02, okay? Spend a little time with this and, see what you can come up with. There are variations of the dogs of the Dow, such as the Foolish Four by the Motley Fool. All right, there's all different ways trying to, boost performance by a few percentage here or there. Just keep in mind, for this video's purposes and the way I look at the January effect, it's very short term. Okay, so a lot of these are, you hold them all year, and that's fine. I'm not saying that they're wrong. I'm just saying that's not exactly how I do it, or it's not even close to how I do it. All right, so remember, this is not the holy grail, despite what the super gurus will tell you. This strategy does lose. This is not a mechanical system. I am telling you about it in mechanical terms. However, it's not a mechanical system. All right? Just because I use 4 days before the end of the year for an entry and 4 days before, for the exit, I'm doing it because I'm recording this on a video and it's going to be archived and people are going to watch this hopefully for years and years to come. So I have to present it as a mechanical system, all right? But it's not a mechanical system. There's discretion involved. There's discretion in picking out the stocks. There's discretion in exiting, all right? So even though I'm presenting it as a mechanical system, it is not one. Use discretion. You must trade smart at all times. And please, again, I'm bringing it up. If you bet it all today, you will not have anything to use tomorrow to trade if you lose. So despite, you may have had a crappy 2011 and you're trying to make it all up, or you're trying to get a head start on 2012, please, that's gambling. It's not trading. It's not investing. It's not good money management. So let's talk about the stock list. Whoa, got to go back. Look at that. Didn't even want me to talk about it. All right. Let's talk about the list of stocks. All right. I have a list of stocks that I'm fine-tuning. You have to go to my website. Okay, stockmarkettrendsx.com. You have to sign up for the mailing list. You'll get a pop-up. There's stuff on the right-hand side. All I ask for is your email. You must confirm that you've signed up. So don't just put a fake email in and then think you're going to, get something, because it doesn't go to the list page. If you sign up and confirm, okay, that you're on the list by checking your email, and it'll say click here to confirm, okay, you will get the list sent out to you. I will be sending the list out at 3 p.m. Eastern. It may take some time to get to you as it cycles through all the names on the list. If you have not received the list by 3:30 p.m. Eastern, contact me at tinymgs@gmail.com. You must provide the email you signed up for the list with, and I will send you the list. But I'm going to confirm that you signed up. Okay? Now, the list will not be given out beforehand to anyone. And I will not be buying any stocks or options on any stocks beforehand. Now, some people may say, well, he's not putting his money where his mouth is. Okay. But the super gurus, the criminals that buy the stocks and options and then give the trades to you and then give you a little disclaimer that I'm going to trade it as I see fit, that's front running. It's illegal. Okay, so despite some super gurus' cries of how they help people, all they are doing is taking advantage of your buying to boost their holdings performance. Okay, so why am I doing this? I'm doing this because I am rolling out my stock and market timing newsletter at the beginning of the year. So yes, I am giving away free information. Just like if you sign up to my email list and get a daily email, you will get free information. Yes, do I advertise my coaching and do I advertise some affiliate relationships? Yes, I do, but it's never a hard sell. Okay? That's not what it's about. I do not try to sell or convince you. If you see the value, you will sign up and you will use the information to assist you in making money. If you don't see the value, you'll move on. All right? That is, I can't lay it out any more on the table than that. I have given out some possible candidates on my blog, stuff like RIM and Netflix and Bank of America, which already bounced. I'm not happy about. All right, so yeah, there's some stocks that I gave out on the blog. I do not own any of them. Okay, and I will not be buying them. And this isn't like, okay, I don't own them, but my kids do. No, okay? The stock that my kids own are stock in Disney. My father-in-law, he actually bought some shares of Disney for my youngest. He just gave us the paperwork on Christmas, okay? Disney won't be, I mean, it may be, I don't know. I don't think it's one of the worst performing Dow stocks, but it may be on there, but not looking to sell Disney into any buying frenzy that I create if you can even create it on a stock that big, okay? So that's the deal with the January effect. If you want my list, then sign up to my mailing list. I'll get it to you. If you don't get it by 3:30, write me an email and say, Tiny, here's the email I signed up with. I haven't gotten, and I confirmed it. I haven't received the list. Please send it to me, and I will send it to you directly from my Gmail account. Okay? Once again, not the Holy Grail, just some analysis that I'm doing. Thank you so much for listening to this almost half-hour video. I trust you found some good in it. Feel free to contact me at that same email and let me know what you think. And that's it. Have a great rest of the year. Have a great new year. And all the best in your trading. Take care.